Hey, everybody, welcome to this week's episode. We've got a juicy, spicy episode for you today, and I can't wait to go through it all with you. This is going to bring, I think, a lot of numbers to the front. So, just right up front, I think it might be helpful if you're able to see the show notes or go to our YouTube channel where you can see some of these numbers in action. It may be valuable and helpful for you to do that. Don't forget to subscribe to our audio podcast so you never miss an episode. And don't forget to subscribe to our YouTube channel because we drop content over there that I don't put on any other platform. So make sure you're seeing that. And we drop content every single day on our YouTube channel. So make sure that you're subscribed to both our audio show on your favorite podcast player as well as our YouTube channel so you don't miss what we're bringing out every single day in some cases. That is a great segue into what we're going to cover today because we've got a lot of juicy, spicy numbers. Now, this is coming directly from a real conversation I had with someone not that long ago who had told me that they had a banking-style whole life insurance policy. I won't tell you the names of the insurance agents or the groups of people, but let's just say you've probably heard of them. They're all over the interwebs and that sort of thing. And they're promoting infinite slash cash flow slash family wealth banking style whole life insurance. I mean, again, there's so many nicknames out there for this and so many insurance agents that would love to sell you a policy that may or may not be properly structured. It's not unlike getting onto an airplane. Airplanes are incredibly simple to fly in. You just get in, buckle in, and off you go. However, there's a ton of engineering that goes into the mechanics of that airplane. You want to make sure that the people who've built that thing knew what they were doing and that you've got a competent pilot who can make sure to land, fly, get you to your destination, all without a lot of turbulence along the way. This is very similar to what I'm going to be describing to you today. So this gentleman was, very happy, so he said, with his existing whole life insurance policy. And what's not to like? He had a mutually owned life insurance company. Check. It was whole life insurance. Check, check. It offered paid up additions in the premium. Again, check marks all around. And the policy was significant in terms of its cash accumulation. By the time I spoke with him, he was in midway through the 9th year of his policy, and he had been truly maximizing the funding of that policy, overfunding it beyond what his planned premium was. We'll get into the details here in just a minute. And so overall, he thought this thing was built correctly. And so as we got into the details, I think he was shocked by what he saw, and I know you will be too. The bottom line is he was losing out on hundreds of thousands of dollars, and the policy was going to train wreck into becoming a taxable endowment in just a few short years. So with that out of the way, without burying that lead, let me get right to the specifics of this guy's situation. Again, I'll take his name and details out of it, but I think it's worth looking at because so many people bring to me their existing insurance or hey, their buddy down the street could design a policy for them, so they thought they'd go ahead and work with their buddy. Guys, I'm telling you, if your buddy was an airplane pilot or said he was, and he got a weekend seminar class on the topic of flying airplanes, would you feel comfortable getting onto his little prop plane, right, to fly over your city? Not me. So let's get into some of the specifics on what was going on with his policy. Maybe if I can explain this to you, you can avoid a similar fate that he was stuck in. All right, so we're going to be really covering the difference between direct recognition and non-direct recognition policy loans. Now, again, some people on the interweb say it doesn't matter, no big deal. You should just get a direct, whichever one gives you the bigger cash value, right? I disagree. I think if we're going to use the cash value for any reason over your entire lifetime, then it's imperative that you use what's known as non-direct recognition. This is what we implore folks to use in the Bank on Yourself ecosystem. It's part of the long laundry list of characteristics and attributes we look for when designing the policies properly. So there are problems, significant problems with direct recognition policy loans. Let's get into some of the specifics of this exact case. So the gentleman I was speaking with, when he was 33 years old, he opened up a policy from, again, one of the top half a dozen mutually owned life insurance companies out there. And it was, again, a mutually owned company. It did offer direct recognition. However, the specifics on this particular policy was that they would still pay some dividends, and I'll show that in just a minute. It was a partial dividend on any account value that was borrowed against. So for those that are less than familiar, just let me give you a quick scenario on what's the big deal. So just to clarify for everyone who may not be as familiar with this as us nerds like myself, direct recognition life insurance policy loans work this way. Your cash value grows just fine without the loans. It just continues to grow with guarantees, also possibly dividends. That's exactly like a bank on yourself policy. The difference comes when you borrow against a direct recognition cash value policy. When you have a loan against a policy that's directly recognizing that you took that loan, the dividends will be reduced or completely eliminated down to $0, meaning you're no longer earning as much or any cash value growth with dividends on any account balance that you've borrowed against. So for example, if you have a $100,000 cash value and you've borrowed $80,000 for any reason, with direct recognition, you'll only be receiving full dividend growth on the remaining $20,000. But with a true bank on yourself design policy, the kind I typically recommend, then the cash value will continue to earn the full dividend on the entire cash value, the full $100,000, as if you had never touched a dime of the money. To me, this is as if your money's doing two things at once. Not so with direct recognition, so we'll see what this means for this poor individual here in just a minute. So he was scheduled to pay a premium of $45,000 a year, but he'd been regularly overfunding that policy now for 9 total years, throwing in on average a premium of $75,000 per year. Again, don't feel like you have to follow his exact numbers. Your policy will be custom tailored to what you can afford. You might be able to put in half that much or a tenth of as much, or you may be able to put in 10 times more than this. The key is just the concepts that we'll be discussing today. So he'd been putting in $75,000 a year on average. His total cash value at the end of year 9 was close to $750,000. Not too shabby for a policy that's got a multi-million-dollar death benefit, which we'll get to in just a minute. Now, he had been heavily borrowing from this policy. In fact, everything has been borrowed out. He had maxed out the policy loan, so he had essentially got a loan balance of $750,000, and he had a net death benefit at that point of $2.84 million. So getting those details out of the way, let's take a look at what the cash and the policy looked like. And the first thing I noticed on the illustration that he sent me, and for those that can't see this, I'll explain this in brief here. So the first couple of pages showed the total cash value on exactly what the cash value was as if the loan had been paid off. There's actually a footnote there on year 9, and I'll go ahead and read that to you. It says that the basic ledger, the big spreadsheet I was just looking at there on his illustration, assumes the loan balance had been repaid as of the date this illustration had been written up and designed. So it says further down the document, there's a outstanding loan that's illustrated showing that loan balance continuing forever. But on this first packet of, big wall of numbers, this spreadsheet, it's going to show and assumes that my client would have essentially paid off the entire loan balance on day 1 of year 9 here. So what we see, and I can see it here, there's a cash value growing. It starts at $770,950. And by year 33, again, that's in year 9. Again, he continues to pay a premium of $45,000 a year, all the way down to year 20, in which case at that point he then lowers down the premium to about $17,700 and continues to pay that all the way down the spreadsheet here. By year 33, when he's 66 years old, his cash value is $4.77 million. Now keep that number in mind, $4.77 million. That's his total cash value in the hypothetical Marvel multiverse world where he paid off his loan completely today, and then by year 33, he has a wiped clean, totally available cash value of $4.7 million. Now, a couple of things. Again, that would assume that he paid off the loan right away. He was unable to come up with $750,000 when I spoke with him, so that's probably not likely going to happen. In addition to that, there was another little footnote I noticed on his spreadsheet. And again, the insurance agent didn't think to tell him this, but in year 13, just 4 years from now, as he continues to fully fund his policy, there's a footnote that said the policy will become a MEC in policy year 13. So first of all, what does that mean? It means that as soon as year 13 rolls around, as he continues to pay not $75,000, but now he's showing in this spreadsheet now a reduced premium of $45,000 a year, and in just 4 more years, his entire cash value, which would be over $1 million at this point, would become a taxable endowment contract, a modified endowment contract, or MEC. It transforms the entire cash value from what would otherwise be accessible with no income tax due to a endowment contract where gains would be taxable to him. He'd also get penalties on loans against the gains of his contract before he's 59 and a half, a 10% penalty to borrow that money out. He was angry when he found this out. I mean, that's in just a couple of years, and it would be even MECing in this year if he continued to fully fund his policy at $75,000 a year, as was his tradition, as his custom. Again, he had owned this policy for 9 years, had heavily been borrowing it from it, had heavily contributed to it. He's put a lot of skin into this program here. A lot of money has gone in, and now it's going to become a taxable event just to access the money. He felt like he'd had the rug pulled out from under him. So we kept reading this footnote, and it says that the 7-pay premium, meaning what he was safe to put in year 13, would have to go all the way down to $28,000 in order to keep the policy from becoming a MEC policy. So his usual amount of $75,000 was not available, and the illustrated amount on his spreadsheet of $45,000 a year also was no longer able to be funded. That was way too much money according to the calculations. To avoid the taxable problem of becoming a MEC policy, he'd have to go all the way down to $28,000 a year and then continue to trim that down to $17,000, meaning he's basically crawling into a cave that's getting a lower and lower ceiling, trapping him into a smaller and smaller ability to fund this account. This all means that he would have way less than $4.7 million by his age 66. What you're seeing on the screen, if you're looking at the screen, or just remember by these calculations, if he fully funded the policy at $45,000 a year and was comfortable becoming a taxable endowment contract, his grand total would be $4.77 million by his age 66. So keep that number in mind. I also want you to briefly notice the dividends. I've got those highlighted as well. The dividend in year 9 was $18,400. In year 10, it was $22,100, and so on. So those dividends continue to grow. Again, this is assuming he never carries a loan on this policy ever again. So what about a world where he does continue to keep that loan balance if he never pays off the loan until the 33rd year, whenever he's 66 years old? What would that look like? Well, in this scenario, he continues to fund his policy. It still becomes a MEC in year 13. Let's set that concept aside for a moment. And his total cash value is only $1.79 million by age 66. So that's dramatically less than the $4.7 million that we talked about just a minute ago. Now, keep in mind, he has that loan balance. We'll come back to that in a minute. But setting aside his cash value and loan balance, just look at the dividends. And again, I've got those highlighted for those watching, but those that are only able to see the show notes or cannot see anything if you're driving right now, the dividends, instead of being $18,000 in the 9th year, $22,000 in the 10th year, we're looking at a dividend far less. He still gets a partial dividend. It's not truly direct recognition because this is still partially paying a dividend. But check it out. His dividend in year 9 was only $10,400 as opposed to $18,000. And instead of in year 10 getting $22,000 of dividends, we're looking at a dividend of only $12,100. Almost cutting the dividend in half just because that loan balance remains on his cash value. This has a devastating impact on the long-term growth capacity of this policy. In fact, exclusively due to the loan balance, we only have $1.7 million in net cash value. And of course, he has that loan balance of $2.5 million by his age 66. But let's hang with those dividends for just a minute longer. Looking at those together side by side, when he has no loan, his dividends look pretty juicy. He has a whopping $1.6 million that he gets to receive as basically dividends or return of premium dividends over these many years from year 9 to year 33. That's a grand total of $1.6 million of dividends. Not too shabby. Now, again, he has partial dividend payments even with that loan outstanding, but the grand total, when you add those up, is only $1.3 million. That's a difference, so $1.66 million versus $1.30 million. So that means he lost $359,682 in dividends merely due to keeping the loan on his policy from year 9 to 33. Can you imagine? Just because you have a loan, you've lost all that dividend power? And by the way, that dividend is being reinvested back into the cash value, which means you're going to have a lot less cash value than even that. So let's get to that next. The total net cash value is $1.79 million, and he does have a loan balance, and you can see it highlighted there, of $2.5 million in year 33. So this means from the time he's got a 5.3% interest rate on this loan, which means he's paying a grand total of $1.7 million of loan interest just to carry this loan over the years between year 9 and year 33. So for 24 years, he accumulates a grand total of $1.7 million of interest that he has to pay to the insurance company. That's a significant price to pay just to carry that loan. So keep an eye on this. If you paid off the loan in year 33, let's just kind of see what that would look like. He would have a grand total of $4.29 million of cash value. Essentially, if you pay off a loan, your cash value becomes freed up and available to use again. So again, with this direct recognition policy loan, he loses a lot of the growth of his money. He had $4.29 million in this policy if his loan balance held on for 24 years. And he would have had $4.77 million of cash value if he had never had a loan on his policy for the last 24 years, from year 9 to year 33. So what's the big takeaway here? Well, again, his total cash value would have been $4.77 million. That's what he would have had if he had never borrowed against his policy or used his cash in any way. But he only ended up with $4.29 million. Again, if he could find a way to pay off that loan when he was 66 years old in the 33rd year. So he only has $4.29 million. That's what he's left with due to direct recognition borrowing. This is a grand total of $475,890 less in cash value simply due to direct recognition borrowing. This is the dramatic problem of direct recognition. When they directly recognize that you have borrowed against your policy, this can have devastating impact. That's $500,000 of just lost money simply due to one or two little sentences in your insurance contract stating that your policy will have a reduced dividend when you borrow against the cash value. And again, what's the additional bonus that we should be paying attention to? Oh yeah, this policy is going to become a mech. It's a train wreck waiting to happen. This means in order to avoid this train wreck, the client would have to dramatically lower down the premium, which would further reduce the cash value to avoid significant tax consequences in the future. So how can we avoid all this? Well, it's a very simple answer. Just work with a bank on yourself professional and build it right the first time. There are so many people who could avoid a lot of this heartache and headache because they would, simply work with someone who'd been trained and certified and has someone watching over their business. I have to make sure that the work I submit and maintain as I work with my clients doesn't get into these kind of problems. And I've additional people looking over my shoulder, you might say, to make sure that the type of policies designed are the kinds that meet all the rigorous requirements and nuanced characteristics that Bank on Yourself talks about and Pamela Yellen writes about in her New York Times best-selling books. So what's the lesson here? Loans on direct recognition policies damage the compounding growth of the cash value. I mean, I think that much is clear. And this is due to lower dividends on cash value merely because of policy loans. It doesn't even count all the loan interest that continues to compound as well. So again, would you rather have $4.7 million of cash value or $4.2 million? I think the answer is clear. Not losing out on $475,000 of cash value purely because of a loan balance makes great sense to me. Now let's compare this to a non-direct policy design where we have a cash value that we can borrow against and it continues to grow even on the capital we borrowed as if there was never a loan taken. So let's take a look at this policy here. This is a policy that by the 10th year has a $396,000 cash value, and we have a $515,000 cash value in year 15. That's what I want you to remember. If you can keep track of all these numbers, if you're driving down the road, if you're watching this, that's fine too. The dividends, however, are something I want you to watch very closely. So the dividends in year 11, 12, 13, 14, 15 are as follows: $9,600, $10,200, $10,800, $11,390, and $11,973. Keep those kind of in the back of your head as well. But remember that $515,000, that's the cash value this particular Bank on Yourself design policy has in year 15. So that was without taking a single loan. Now, in year 11, let's presume that you take a loan against your cash value. Remember, in year 10, the cash value was $396,000. So in year 11, let's go ahead and take a loan for $350,000. Notice the dividends, even after you took the loan out, basically for all of your cash value, remain exactly the same. You still get the entire dividend payment as if you had never touched a dime of your money. That's the non-direct recognition loan advantage right there. We're continuing to get that uninterrupted compounding as if there was no loan. Now, most people presumably will pay off loans over a reasonable period of time. This screenshot here shows the loan continuing forever and the policy runs just fine. And by the way, this is a non-MEC policy. But now let's go ahead and pay back the loan. Let's pay back the loan in years 11 through 15. Notice the cash value in the 15th year is exactly the same. We still have a cash value of $515,913. That's the exact same amount you would have had you never borrowed the cash value in the first place. So the cash value and, by the way, the death benefit are precisely the same as before. So you did not lose any opportunity cost when accessing your cash with non-direct recognition loans. And as one more reminder, you are in complete control of repaying the policy loan that you own and control here. Now, just as a side note, for those interested, the policy loan interest was a total of $38,200 spread out over 5 years. That works out to an APR, an annual percentage rate, of only 2.1%. Not a bad deal when you think about where interest rates are in our world today. The APR on this being that low means this money is accessible at a very reasonable rate. So what are some takeaways as we wrap up this episode? Well, the first, and I think maybe the last, is get a policy with a non-direct recognition policy loan provision. This is what we call Bank on Yourself designed. It's one more reason to work with a Bank on Yourself professional so that you can ensure that your policy's cash value continues to grow on the entire account value, even on the amount you've borrowed against. Now, I showed you basically the best looking direct recognition insurance company. I'm not going to name the name on this. If you want to know the name, reach out to me directly and we'll talk about it. But the best possible mutually owned direct recognition insurance company still had that kind of a penalty to borrow their own cash. Your cash, that's your cash there. Can you imagine other insurance companies, again, mutually owned, that are true, complete direct recognition, where the cash value truly earns zero as you borrow against it? That would have an even worse effect on your ability to spend that money for kids' college, for your next car, for your real estate investment, or even worse, the 20 to 30 years of retirement income you might decide to pull against this policy in retirement. Can you imagine just how bad the life insurance policy would perform if it was direct recognition and you're spending that money down over retirement. So I would much rather have a true bank on yourself designed policy. This is a short checklist, not even a complete checklist, but a short checklist of all the things that insurance agents must do to design the policies the correct way, the bank on yourself way. For example, does my policy have non-direct recognition loans, or are they direct recognition loans? But there's so many others on this checklist here, and we'll put this in the show notes as well. Does my policy even pay dividends? Sometimes they don't. Are the dividends based on company performance that's been paid out for over 100 years? Is there significant dividend variability where the dividends might fluctuate dramatically if the insurance company is in some sort of hot water, financially speaking? Are there other riders that allow me to access my cash or death benefit for chronic illness or long-term care needs? Is this a stock-owned company or a mutually owned company? I mean, the list goes on and on here, but the point is hopefully clearly made. You want to work with someone who knows how to design your bank on yourself designed policy. Again, much like an airplane, get into an airplane that's been properly structured, engineered well, and flown by a proper educated pilot, and all you have to do is get in, buckle in, and fly. It's very simple for those that had the thing designed properly from the start. If not, you're going to be having to unwind, like my client was, having to unwind his policy, transfer it over, and doing a 1035 exchange into something now that he's 9 years older. So, I hope that this has been helpful for you. Give me a call, reach out to me, and directly talk with me about your situation, your issues, your concerns, or maybe you've got a policy from years ago. You can go to nyafinancialpodcast.com and click on Request a Meeting to schedule a time, and either myself or one of my colleagues would be happy to meet with you to go over these questions and more. So hope all this has been helpful. Thank you for joining me for this week's episode of Not Your Average Financial Podcast, helping you think and live differently with your money, your economy, and your future.